What you are about to hear is a case study in modern financial fragility. This is not a tale of reckless gambling, addiction, or medical ruin. This is the story of how a financially prudent individual, with an excellent credit score and a stable business, was systematically dismantled by the silent, automated, and interconnected systems of modern credit in less than 12 months. I went from approving six-figure loans to standing in a kitchen so quiet I could hear the digital hum of a disconnected refrigerator. My family was gone, my assets were being seized, and my FICO score was in free fall. The cause was not a single catastrophe, but a predictable chain reaction, a pebble of professional setback that triggered an algorithmic avalanche. I will guide you through a forensic autopsy of this collapse, the strategic errors, the psychological traps, and the contractual clauses that conspired to create a perfect storm. This is an analysis of how indifference, the cold, procedural indifference of systems designed to manage risk, not people, became the most destructive force in my life. By the end, you will understand not just my story, but the underlying architecture of vulnerability that exists in countless financial profiles. This knowledge is not meant to frighten you, but to fortify you. What follows is the blueprint of a disaster, so you can reinforce your own foundations before the first crack appears. The first month after the client's departure was characterized not by panic, but by a quiet, professional arrogance. I had built a buffer for a reason. The severance of that revenue stream was a setback, not a crisis. The plan was simple and, in my mind, infallible. We would cut discretionary business spending. I would forgo my salary temporarily, and we would use our existing lines of credit to cover operational costs, primarily payroll and vendor payments, until we secured a replacement client. This was, I told myself, the very purpose of credit. It was a financial shock absorber. My personal excellent credit was a tool in my professional toolkit. This fundamental misclassification, viewing personal creditworthiness as a business liquidity tool, was the crack through which the entire foundation would later crumble. I initiated what I called the strategy of silence. Internally, my partner and I knew the situation. Externally, there was to be no signal of distress. We did not inform our remaining clients, our vendors, or most critically, our primary bank. In the modern commercial ecosystem, perception is inextricably linked to risk, and risk is quantified by algorithms I could not see. I believed that requesting modified payment terms or revealing cash flow concerns would trigger scrutiny we could not afford. Instead, I began a carefully calculated dance with my personal credit cards. The business had its own corporate card, but its limit was modest. My personal cards, however, with their combined limits nearing $100,000, represented a deep reservoir of potential capital. I began using them for legitimate, sizable business expenses. A critical software annual license, a travel deposit for a potential client meeting, a bulk order of supplies to secure a discount. I would transfer the balances later, I reasoned, once the new contract was signed. The first tangible blow came not from a human being, but from an automated risk model. It arrived not as a dramatic phone call or a letter in red ink, but as a single, bland sentence in the monthly statement for my oldest credit card, the one with the highest limit and the most pristine history. Please be advised, your credit line has been reviewed and adjusted to $15,000. It had been $35,000. I stared at the line, my mind performing a rapid and horrifying calculation. I had carried a balance of approximately $12,000 on that card from the recent business expenses. My utilization on that account had just leapt from 34% to 80% in a single, silent administrative action. I called customer service, adopting a tone of confused indignation. The representative, polite and scripted, explained it was a periodic review based on information in my credit report and spending patterns. My arguments about a perfect payment history were met with empathetic, algorithmic silence. The system had detected a change in profile, perhaps the increased spending, perhaps a nascent trend it identified before I could, and had moved to mitigate its exposure. The shock was not just financial, it was philosophical. My credit was not a static asset I controlled. It was a dynamic assessment controlled by others, and it could be withdrawn unilaterally. This event triggered the second, more devastating domino, the cross-collateralization trap. Years prior, when my business and personal finances were flush, I had taken out a home equity line of credit on my paid-off house. The banker had presented it as the smart money move, a low-interest reserve for investment or opportunity. It also served as a secondary personal guarantee for my business's smaller line of credit at the same institution. The paperwork was a blur of legalese I had signed with the confidence of prosperity. When the bank's commercial side noted the dip in my business revenue and their automated systems, which undoubtedly shared data with the consumer side, received the update of my reduced personal credit limit and likely the associated credit score drop, a flag was raised. A human being in the risk department likely saw a file where two connected entities, my business and I personally, were showing simultaneous signs of stress. I received a certified letter. The bank, exercising its right under the loan agreement, was conducting a financial review of the HELOC and was immediately suspending further draws. Furthermore, they were invoking a clause that required a reevaluation of collateral. Within 3 weeks, their conclusion arrived. The combined loan-to-value ratio on my home was now, in their revised estimation, outside acceptable parameters due to market volatility and increased borrower risk profile. They demanded a lump sum payment of $40,000 to bring the line into compliance, or the entire outstanding balance would be called due. The air left my lungs. The HELOC was not just a safety net, it was the very bridge I had planned to use to pay down the credit cards once new revenue arrived. Now, the net had vanished, and the bridge was collapsing behind me. This is when the psychology shifted fundamentally, from strategic manager to desperate tactician. The overarching goal of saving the business narrowed day by day to the obsessive, spreadsheet-driven goal of preventing a missed payment. The moral weight of debt was replaced by the mathematical logic of cash flow triage. I would lie awake, not thinking about the total debt figure, which was swelling from interest and fees, but running sequences. If I pay the minimum on card A 2 days late, the fee is $35, but it won't report for 30 days. If I take the cash advance from card B to cover card C's minimum, the fee is 5%, but it buys me 28 days. The mortgage must clear. The car payment can float for the grace period. I was no longer a businessman. I was an air traffic controller in a tower filled with blinking, incoming red lights, trying desperately to prevent a single collision, knowing a mid-air disaster was inevitable. The spreadsheet became a living document of my decay, each tab a monument to a different facet of the crumbling facade. The interest charges, once an afterthought, became a malignant line item that now exceeded what my family had once spent on utilities and groceries combined. I was no longer spending money. I was purchasing days, and the price was escalating at a usurious, exponential rate. The cascade was no longer a series of isolated events. It was a synergistic flood, each wave reinforcing the next, pulling me deeper into a vortex of contractual obligations and compounding penalties from which there seemed to be no surface, only a descending, darkening pressure. The financial mechanics of the collapse, while complex, existed in a realm of numbers and contracts. They were, in a cold sense, logical. The human dimension, however, operated on a different plane, one of unspoken fears, eroding trust, and a profound, isolating shame. This was the silent panic, a pressure building behind a carefully maintained facade, far more corrosive than any interest rate. The most significant fracture was the one that crept into the foundation of my home, my marriage. My wife, Sarah, was aware of the initial client loss and our tightened budget. We had agreed on the bridge financing strategy. However, as the strategy mutated from a short-term tactic into a relentless financial quagmire, I began to edit the narrative I shared with her. I moved from partner to protector, a shift that was both arrogant and born of a desperate love. I believed that shielding her from the escalating severity of the situation, the credit limit reduction, the HELOC call, the spiraling minimum payments, was a form of stewardship. I told myself I was absorbing the stress so she could provide a stable home for our young son. Our conversations became a dance of implication and avoidance. "How did the call with the bank go?" she would ask. "It's handled," I'd reply, a statement that was technically true, only in the sense that a call had occurred, not that the outcome was favorable. My physical presence at home became a performance. I would leave the chaos of my home office, where spreadsheets glowed and envelopes piled up, and enter the living room with a practiced, weary smile. I engaged in bedtime stories with our son, the words on the page a meaningless mantra, while my mind computed payment deadlines. The dissonance was exhausting. Sarah is perceptive. She sensed the gap between my reassurances and the increasing tension in my shoulders, the distracted gaze, the shorter temper. A quiet distance grew, measured not in arguments, but in the lengthening silences over dinner and the gradual cessation of shared future plans. The "when we get through this, we should" conversations that simply stopped. The catalyst for the rupture was not a dramatic confession, but a mundane discovery. A statement from a credit card I had told her was under control arrived in the mail. I had missed intercepting it. She opened it, seeing not just the $18,000 balance, but the plethora of cash advance fees and the punitive 29.99% APR that now applied. The number was a tangible, irrefutable artifact of the disaster I had been verbally minimizing. The confrontation was quiet, devastating. It wasn't about the money anymore. It was about the breach of trust. "You lied to me," she said, not with anger, but with a hollow disappointment that was infinitely worse. "You've been lying to me every day by omission. We're supposed to be a team in this life, not you managing me as another liability." In that moment, I wasn't a failed businessman. I was a failed partner. The isolation I had sought to impose upon her to spare her worry had now been transferred to me in its entirety. I was alone with the consequences. This internal collapse mirrored a parallel performance I had to maintain in my professional life. The strategy of silence extended beyond creditors to clients and employees. On video calls, I was the confident leader, articulating strategies and projecting control. Meanwhile, a separate browser tab was always open to my online banking, a silent, pulse-sharing counterpoint to my professional dialogue. I cultivated a heightened, almost manic, attention to detail in client work, over-delivering as if to compensate for the instability I feared they might sense. The psychological toll was immense. Imposter syndrome is commonly discussed. This was something darker, a state of being a genuine fraud. My professional identity, once a source of pride, felt like a costume I was wearing over a failing infrastructure. The fear was paralyzing. If a single client perceived a hint of financial distress, the remaining revenue could evaporate, finalizing the doom I was trying to avoid. This cocktail of shame and isolation made me susceptible to the very predators who orbit financial disasters. In my desperation for a lifeline, a Hail Mary that would circumvent the grim logic of my spreadsheets, I began searching for unconventional solutions. I found a website for a firm promising legal credit repair, using federal statutes and loopholes the banks don't want you to know. They spoke a language of empowerment and defiance, precisely what my battered ego craved. For a $2,000 retainer, they promised to dispute all my debts, force validations, and essentially cleanse my credit reports through procedural warfare. It was a fantasy of technicality triumphing over reality. I paid using the last of a cash advance from a card not yet maxed out. For a few weeks, I felt a glimmer of illicit hope. Then, the template letters they sent on my behalf were met with verified validations from creditors. The charge-off processes continued unabated. The firm became unresponsive. The realization that I had been scammed was a unique nadir. The banks were impersonal adversaries following their rules. This was a deliberate, targeted exploitation of my desperation. The $2,000 was gone, but the greater loss was the last vestige of the belief that I could outsmart the situation. This series of humiliations, the marital fracture, the professional charade, the victimization by a scam, culminated not in a dramatic breakdown, but in a profound emotional numbness. The constant, acute panic that had been my adrenaline-fueled state for months finally burned out its receptors. I remember the day with crystalline clarity. I was sitting in my car outside the post office, holding a final notice for the repossession of my car, which I had foolishly used as collateral for a short-term loan months prior. The loan was in default. I had expected to feel a surge of terror, a final, frantic need to act. Instead, I felt nothing. A cold, quiet void. The metaphorical ship had not just hit the iceberg, it had finished its descent to the ocean floor. The pressure was immense, but it was equalized. The frantic struggle to stay afloat was over. I was sitting on the bottom, and in that stillness, for the first time, I could see the wreckage around me with absolute, unflinching clarity. The panic was replaced by a grim, almost peaceful resolve. The fight to preserve the past was over. The question now was whether there was a future to be built from the debris. The numbness that followed the repossession notice was not an ending, but a strange and necessary beginning. The emotional energy required for denial, for performance, for frantic triage was entirely depleted. What remained was a cold, operational clarity. I was no longer a drowning man. I was a diver at the wreck site, tasked with cataloging the damage. This shift in mindset, from victim to forensic investigator, was the single most critical pivot of the entire ordeal. It marked the end of reactive desperation and the start of a strategic, albeit painful, reconstruction. The first step was the total abandonment of the strategy of silence. I began with the most important relationship, my family. The conversation with Sarah was devoid of the euphemisms and optimism that had poisoned our communication before. I presented the data, not as a plea for sympathy, but as a briefing. I laid out the spreadsheets, the collection letters, the credit reports. I outlined the chain of events not as a series of misfortunes, but as a sequence of decisions, some forced, some foolish, that led to our current coordinates. There were tears, yes, but they were of grief and relief, not of panic. The wall of my solitary burden was demolished, and while the landscape it revealed was bleak, we could now survey it together. We made a pact, radical transparency, no matter how ugly the detail. This was no longer my problem to solve. It was our situation to manage. The isolation ended in that moment. Concurrently, I initiated a formal, systematic audit of the destruction. I obtained full reports from all 3 major credit bureaus, not just the summarized scores from monitoring services, but the dense line item reports that list every account, its status, its payment history, and its notations. I created a master ledger, but this one was not for cash flow management. Its purpose was to map the kill chain, the precise, interlocking sequence of failures. The revenue shock, the non-renewal of the key client contract, the strategic error, the decision to use personal credit as a business bridge, violating the firewall between personal and corporate liability. The algorithmic trigger, the unilateral reduction of my primary credit limit, which artificially spiked my utilization and began the credit score descent. The institutional risk mitigation, the bank's cross-collateralization review, and the calling of the HELOC, which removed the planned escape hatch and created an immediate, insurmountable cash demand. The mathematical certainty, the snowball effect of minimum payments, penalty APRs, and late fees, which guaranteed the exponential growth of the debt despite all payments being made. Seeing it laid out in this cause and effect sequence was revelatory. The disaster was not a random act of God. It was a predictable, almost mechanistic process. Each element had triggered the next. This understanding stripped the situation of its emotional horror and recast it as a series of problems to be solved, in reverse order. This forensic clarity informed the next deeply counterintuitive phase, proactive strategic communication. The instinct when drowning in debt is to hide, to ignore calls, to throw away unopened envelopes. I had been following that instinct. Now, I adopted a new protocol. I divided my creditors into 2 categories. Those I believed I could eventually satisfy, and those where the debt was so large relative to my income that it was functionally insurmountable. For the first group, I began making calls. My script was starkly different from prior pleas. It was factual and unemotional. My name is your name. I am calling regarding account number. I am experiencing a severe financial hardship and cannot maintain the current payment terms. My current total monthly income is X dollars. My necessary living expenses are Y dollar. I am calling to discuss what hardship or settlement programs you offer. I had my figures in front of me. I did not offer elaborate excuses. I presented my reality as a simple mathematical equation they were now a part of. To my astonishment, several creditors offered temporary hardship plans, reduced interest rates, waived fees, or lower minimum payments for a set period. One even offered a settlement for 40% of the balance if I could provide a lump sum from a family loan I now felt able to request honestly. For the second group, the large charged-off debts, I engaged a different strategy. I ceased all token payments. This was not an act of defiance, but of economic rationality. A $100 payment on a $30,000 debt being pursued by a collection agency was financially meaningless and only drained resources needed for rebuilding. I allowed the statutory and legal processes to continue, knowing my rights regarding validation of debt and statute of limitations. This was the most psychologically difficult part. Every instinct screamed to pay something. But the forensic audit showed clearly that these sinking ships could not be saved, and attempting to do so would only pull the lifeboats under. The final and most painful piece of strategic action was the formal wind down of my business entity. The LLC, which was once my proudest achievement, was now a hollow shell with liabilities. Consulting with a lawyer, paid for with funds from a familial safety net I had been too proud to previously consider, I initiated dissolution proceedings. This was a funeral. There was profound grief in filing the paperwork, in notifying the state, in closing the business bank account. But it served a vital purpose. It legally severed the remaining ties between my personal catastrophe and the corporate structure, protecting my personal assets from any future business-related claims, and finally, irrevocably, firewalling the two worlds. It was the concrete action that embodied the lesson learned. The separation of church and state is not a convenience. It is a survival imperative. By the end of this phase, the chaotic storm of my financial life had been replaced by a grim, static battlefield. The active bleeding had been cauterized through hardship programs, strategic non-payment, and legal dissolution. The debt had not vanished. It had been organized, categorized, and quarantined. The feeling was not of relief, but of exhausted, hard-won stability. The floor beneath me was cold and solid rock. It was not where I wanted to be, but for the first time in a year, I was no longer falling. I was on the bottom, and from here, the only possible direction was to begin the slow, deliberate climb upward. The tools for that climb, I realized, would not be financial instruments, but new principles. The climb out of financial collapse is not a sprint toward a repaired credit score. It is a deliberate, principle-based reconstruction of one's entire economic philosophy. The previous facade of stability was built on appearances and access, high limits, favorable rates, the allure of available capital. The new foundation would be built on liquidity, separation, and a ruthless commitment to transparency, both internally and externally. This was the development of an anti-fragile financial mindset, a system designed not just to withstand shocks, but to gain strength from the process of overcoming them. The first and most sacred principle became the separation of church and state. The firewall between personal and business finances, which I had so catastrophically breached, was now codified into an inviolable rule. Any future entrepreneurial endeavor would require its own capital, its own banking, and its own legal structure. Personal guarantees would be viewed with extreme prejudice, understood not as helpful tools, but as potential suicide pacts. This was not merely a practical step, it was a psychological one. It forced a clarity of thinking where business risk was contained, and personal solvency was protected as the non-negotiable bedrock of all other endeavors. The second principle was the primacy of liquid cash. I had worshipped at the altar of credit availability, mistaking it for true wealth. The new metric of security became the emergency fund. We started with a literal locked box for spare change and small bills, a tangible off-grid reservoir. Every resource was directed toward building a buffer of actual currency in a savings account, even as we addressed outstanding debts. The goal shifted from what can I afford if I put it on a card to do I have the cash for this? This reorientation was profoundly empowering. A $1,000 savings balance, earning negligible interest, provided more genuine security than a $10,000 credit line ever had. It was money that could not be algorithmically withdrawn, could not trigger a utilization spike, and required no one's permission to use. The third principle was proactive communication as a strategic tool. I had learned that silence was interpreted by the system as either consent or guilt. Therefore, I adopted a policy of controlled factual disclosure. When I opened a secured credit card with a deposit of $300 that constituted a significant portion of our emergency fund at the time, I did so without shame. It was a tool, not a testament to my worth. When I took out a small credit builder loan from a local community credit union, I treated the monthly payments with the solemnity of a religious observance. This was not about the money. It was about creating an undeniable, algorithm-friendly trail of positive behavior. Each on-time payment was a brick in the new foundation, carefully laid for the sole benefit of the electronic overseers whose confidence I needed to rebuild. This granular, process-oriented work yielded psychological rewards long before the numbers reflected it. The first time a monthly statement from the secured card showed a zero balance and an on-time payment notation, I felt a surge of accomplishment more genuine than any previous approval for a high-limit card. The credit builder loan, arguably a financial triviality, became a monthly ritual of discipline. We would log in together, schedule the payment, and acknowledge the small victory. These actions were not moving the needle on our net worth, but they were fundamentally rewiring our relationship with money from one of anxiety and abstraction to one of control and concrete action. The unexpected, transformative gifts of this period were not financial, but philosophical and relational. The humility that replaced my professional arrogance was a relief. I was no longer an expert pretending to have all the answers. I was a student of a hard lesson, and that posture was lighter to carry. The depth of partnership with my wife, forged in the fire of total transparency, created a level of intimacy and shared purpose we had not possessed during the prosperous years. We were a true team, budgeting not as a restriction, but as a collaborative project to reclaim our future. Most importantly, I abandoned the credit score as a proxy for self-worth. Instead, I became obsessed with a new metric: net worth. Initially, this number was deeply negative, a sobering summation of all liabilities. But tracking it monthly, without flinching, became the truest measure of progress. As we slowly paid down debts and built microscopic amounts of savings, the line on the net worth graph began, imperceptibly at first, to tilt upward. This was real, unassailable progress. It represented a claim on my own future that no bank could rescind. The FICO score would eventually follow this lead, but it was now a lagging indicator, a thermometer reflecting the health of the organism, not the diagnosis itself. The reconstruction, therefore, was not a series of clever financial hacks. It was the meticulous application of a new, resilient operating system. It valued control over appearance, substance over signal, and collaborative truth over solitary performance. The stability that began to emerge was not the polished, fragile glass of before, but the rough, durable texture of reinforced concrete, forged under pressure, tested by failure, and designed to last. As I record this, it has been 18 months since the day I received the repossession notice in my car. The silence in my house now is a different kind. It is not the chilling silence of isolation and hidden disaster, but the quiet hum of a managed reality. The peaceful sound of my son playing in his room while my wife and I work at the kitchen table on our monthly budget review. My credit score, for those who view that as the finish line, is 684. It is climbing steadily, predictably, by about 8 to 10 points every quarter. But that number now feels like a temperature reading, a useful data point, not a verdict on my character or potential. The stability I have rebuilt is not the glittering, precarious castle on a hill I once inhabited. It is a modest, fortified home on solid ground, with a well-stocked cellar and clear lines of sight in every direction. The collapse taught me that personal finance is not a static state of being, but a dynamic ecosystem. It can appear lush and stable while, underneath the canopy, a single root is rotting. We are led to believe that the predators in this jungle are profligate spending or unexpected tragedy. But the more dangerous animals are indifference, complexity, and interconnection. The algorithms that adjust your limits, the cross-default clauses buried in loan agreements, the risk models that quietly shift. They are not evil. They are profoundly indifferent to the personal narrative of a sick child, a lost client, or a dream faltering. And that institutional indifference to your individual story is, I have come to understand, the most powerful and dangerous force in the modern financial landscape. My failure was in believing my good history would protect me, that I was a partner to these institutions rather than a data profile in a risk management spreadsheet. This is why I'm sharing this story in such detail. My descent from financial stability to credit collapse is one specific blueprint of a disaster, but the architectural principles are universal. The chain reaction of a revenue shock, a strategic misuse of credit, algorithmic triggers, and contractual traps can manifest in 1,000 ways, through medical debt, a divorce settlement, a failed investment, or a small-town business caught in a supply chain breakdown. The patterns are eerily similar, only the inciting incident changes. This realization is what led me to the work we are now building. On the YouTube channel, Credit Comeback Stories, we do not traffic in simple hacks or listicles about best credit cards for cashback. We perform forensic audits of financial collapses. We deconstruct these chain reactions, not to assign blame, but to illuminate the wiring. We interview people who have navigated the aftermath of medical bankruptcy, divorce-related financial devastation, cryptocurrency wrecks, and small business implosions like my own. Our mission is to provide the clear-eyed, strategic understanding I so desperately needed when I was in the thick of it. The understanding that separates a temporary setback from a full-blown systemic collapse. If you are listening to this and feel the first chill of unease, perhaps you're using one credit card to pay another, or you've just received a notice you don't fully understand, or you're privately maintaining a facade for your partner, you need to watch our next video. We break down the early warning signs that are so easy to rationalize away. If you are currently in the spiral, feeling the shame and isolation that compounds the financial fear, you need to watch our next video. We provide the framework for that crucial pivot from victim to forensic investigator, for initiating the difficult conversations, and for building your first real plan. And if you are on the other side, proudly viewing an 800+ credit score as a shield of invincibility, I would argue you need our perspective most of all. Complacency is the most fertile ground for these seeds of disaster. Understanding the fragility within complex systems is the only true form of strength. We are building more than a channel. We are building a community focused not on shame, but on strategic resilience. A community that values transparency over pretense and principles over quick fixes. Subscribe to Credit Comeback Stories on YouTube. Hit the notification bell. We are here to equip you with the tools of understanding so you can audit your own position, reinforce your weak points, and navigate with clarity. Because the most inspiring story is not about never falling. It is about comprehending the exact mechanics of your fall and using that hard-won knowledge to build something truly unshakable. Your comeback starts now.